15 minutes. In financial markets, that's not just a short amount of time, it's almost no time at all. It's the gap between a routine trade and something that makes people stop, rewind the tape, and ask uncomfortable questions. On the morning of April 9th, 2025, markets were already under pressure. The mood was tense, fragile, and leaning heavily toward fear. Investors had spent days watching prices slide as uncertainty around global trade policy, and it wasn't just a mild pullback, it felt like the kind of environment where people start preparing for something worse. And then, in the middle of that chaos, someone placed a trade. Not a small one, not even a large one by typical standards. We're talking about a position reportedly worth hundreds of millions of dollars, concentrated into same-day call options tied to the S&P 500. These are instruments that expire within hours. They're designed for precision, not patience. You don't buy them because you think the market will recover eventually. You buy them because you believe something is about to happen very soon. That alone would have been enough to raise eyebrows. But what happened next is what turned it into a story. Roughly 15 minutes later, a policy announcement hit the public. The tone shifted instantly. Markets, which had been sliding for days, reversed with stunning force. The S&P 500 surged dramatically within the same afternoon, logging one of the most aggressive single-day moves in recent memory. And just like that, the trade worked perfectly. Now, before jumping to conclusions, it's important to slow down and understand the mechanics here, because this is where things start to feel less like coincidence and more like something that demands closer inspection. Same-day options fan, called zero-day Stuxperation or ODTE. Options are among the most high-risk instruments available in modern markets. They are extremely sensitive to price movement. Small changes in the underlying index can produce outsized gains or wipe out the entire position before the closing bell. Think of it less like investing and more like timing. You're not predicting direction over weeks or months. You're making a very specific bet about what will happen within hours. And here's the key detail. If nothing significant happens, those options typically expire worthless. So when a position of that size appears in that kind of environment during a market downturn, with sentiment overwhelmingly negative, it naturally stands out. Professional traders monitor unusual activity constantly, and trades like this tend to get noticed quickly. But unusual doesn't mean illegal. Markets are full of bold bets. Every day, someone takes a position that looks extreme in hindsight. Most of the time, they're wrong. Occasionally, they're right. The real question is how right and how precisely timed, because, in this case, the timing wasn't just good, it was exact. The trade appears to have been placed shortly before the announcement that triggered the move it was positioned to benefit from. Not hours before. Not the day before. Minutes. In markets, timing is everything. But timing like that is rare. To understand why, you have to look at what the broader market believed at that moment. Leading into that day, the dominant narrative was bearish. Trade tensions had escalated, and investors were adjusting expectations accordingly. Analysts were lowering forecasts. Volatility was rising, and capital was moving into defensive positions. In other words, the consensus view was not that the market was about to rally sharply. That matters because markets don't just move based on news, they move based on how that news compares to expectations. If everyone expects good news, and it arrives, prices often barely react. But when something unexpected happens, that's when you see explosive moves. And that's exactly what unfolded. The announcement introduced a sudden shift in expectations. Whether it was interpreted as a temporary easing of pressure or simply a pause in escalation, it changed the narrative instantly. That gap between expectation and reality is what drove the magnitude of the move. Which brings us back to the trade. Because for that position to perform as well as it did, it wasn't enough to simply guess that markets would go up. The structure of the trade suggests a belief that markets would move quickly, significantly, and within a very narrow time window. That's a much more specific kind of prediction. Now, it's entirely possible at least in theory, that this was a high-conviction macro bet. Markets do occasionally reward bold positioning. There are traders who specialize in identifying moments where sentiment becomes too extreme, where the probability of a reversal increases. But, even then, the precision here is what keeps drawing attention. 15 minutes is not a long time to go from uncertainty to certainty. This is where discussions often shift toward the concept of information. Not all information in markets is equal. Public information is available to everyone at the same time. Private or non-public information, on the other hand, creates asymmetry on uneven playing field. Modern financial regulation is built around limiting that asymmetry, particularly when it comes to material information that can move markets. But there's an interesting nuance here. Most insider trading frameworks were designed around corporate information earnings reports, mergers, acquisitions, things controlled by companies and their insiders. Government policy decisions, especially those made at the highest levels, exist in a slightly different category. They can still move markets just as dramatically, sometimes more so, but the pathways through which that information flows are less clearly defined. That doesn't automatically imply wrongdoing. It just means the situation becomes harder to analyze cleanly. And that's part of what makes this story so compelling. Because when something like this happens, multiple interpretations emerge at once. One interpretation is that it was an extraordinary coincidence. A trader made a bold, well-timed bet and got rewarded in a way that looks almost unbelievable in hindsight. Another interpretation is that the trader may have had access directly or indirectly to information that wasn't yet public. There are also shades in between. Markets are complex ecosystems. Information leaks in subtle ways. Sentiment shifts before headlines. People talk. Signals emerge that aren't immediately visible to everyone. The challenge is distinguishing between intuition, inference, and actual foreknowledge. And from the outside, that's not easy to do. What is clear is that trades like this tend to trigger attention, not just from other traders, but from compliance teams, exchanges, and regulators whose job is to monitor unusual market activity. Large, concentrated positions placed shortly before major market-moving events are exactly the kind of patterns those systems are designed to flag. That doesn't mean anything improper, could it? Simply means the activity stands out enough to warrant a closer look. And historically, markets have seen moments like this before. Not identical, but similar in spirit instances, where unusually well-timed trades prompted questions about how information travels and who has access to it. Sometimes those questions lead to clear answers. Other times, they don't, because proving intent, especially in financial markets, is incredibly difficult. It's one thing to observe a pattern. It's another to demonstrate that the pattern resulted from knowledge that shouldn't have been available. And that gap between suspicion and proof is where most of these stories live. What makes this particular case different, though, is the scale and the visibility. This wasn't a quiet trade buried in obscure securities. It happened in one of the most liquid, heavily monitored markets in the world. It happened in broad daylight, and it happened right before a moment that moved trillions of dollars in value. That combination says timing and impact is what keeps people talking. Because even in a market built on probabilities, there are moments that feel improbable. And when those moments appear, they tend to linger. Not because they prove anything on their own, but because they raise a question that's hard to ignore. Was this just an extraordinary bet, or something more? And that question doesn't fade quickly when there are hints that this may not be the only time something like this has happened. Because here's where the story starts to shift from a single moment into a pattern. In the days that followed April 9th, people didn't just focus on that one trade. Analysts, journalists, and a handful of quantitative researchers began doing what markets always do after something unusual happened. They went back and looked for precedents. Not rumors. Not opinions. Data. They pulled options flow, trade timing, and market reactions around other major policy announcements over recent months. And what they were looking for was simple. Was this a one-off anomaly? Or had similar positioning shown up before key events? What they found, at least in some cases, raised eyebrows. There appeared to be instances where short-dated options activity clustered unusually close to policy announcements that later moved markets in meaningful ways. Not every time, not perfectly, but often enough that it didn't feel entirely random. Now, it's important to be careful here. Financial markets generate enormous amounts of data every day. If you look hard enough, you will always find patterns that look significant in hindsight. Humans are wired to connect dots, even when those dots may not be causally related. But there's a difference between random clustering and repeated, well-timed positioning around events that weren't widely expected. And that's where the conversation starts to get uncomfortable. Because if it is just coincidence, it's a remarkable one. But if it's not, then it points to something deeper, not just about one trade, but about how information moves through the system. At the center of that system are mechanisms designed to catch exactly this kind of activity. Large financial institutions have compliance teams whose entire job is to monitor trading behavior. Exchanges track order flow. Regulators have access to detailed audit trails that can reconstruct who traded what, when, and through which accounts. In theory, nothing in modern markets is truly invisible. So when a trade stands out, especially one of this size and time in it, doesn't go unnoticed, it gets flagged. It gets reviewed, and in some cases, it triggers formal reporting processes that escalate the activity to regulators. That's the system, working as designed. But here's the part that rarely gets discussed publicly. Identifying unusual activity is only the first step. What happens after that depends on factors that go beyond the data itself. Investigations take time. They require resources, and most importantly, they require a clear path to proving that something inappropriate actually occurred. That's harder than it sounds, because to move from suspicion to enforcement, you don't just need to show that a trade was wet. You need to establish that the person placing it had access to material information that wasn't available to the public and that they acted on it. That's a high bar, and in cases involving corporate insiders, executives, bankers, lawyers, that framework is relatively well understood. There are clear duties, clear restrictions, and decades of legal precedent. But when the information in question originates from government policy decisions, the lines can become less defined. Policy decisions aren't owned by a single entity in the same way corporate information is. They could involve multiple agencies, advisors, and communication channels. Information can circulate internally in ways that are difficult to map from the outside. Again, none of that implies misconduct. It just makes the process of proving anything far more complex, and complexity, in regulatory environments, often translates into slower outcomes or sometimes no outcome at all. Which brings us back to April 9th, because while the trade itself settled within hours, the questions it raised didn't. If anything, they've grown more persistent over time. Who placed the trade? Was it a single entity, or multiple participants? Was it based on conviction, inference, or access to information others didn't have? From the outside, those questions remain unanswered. And that uncertainty is what gives the story its staying power. There's also a broader implication here, one that extends beyond any individual trade. Financial markets operate on trust, not blind trust, but a baseline belief that the rules are applied consistently, and that no group has a systematic advantage based on information that others can't access. When that belief holds, markets function efficiently. Capital flows, risk is perceived, participation remains high. But when that belief starts to weaken, ebb and slightly, the effects can ripple outward. Because traders don't just react to prices, they react to perceived fairness. If participants begin to suspect that certain players consistently have better information, it changes behavior. It alters risk tolerance. It shifts how capital is allocated, not overnight, but gradually, and that's why moments like this matter, regardless of the final explanation. It's not just about whether one trade was legitimate or not. It's about how the system responds to the possibility that something might be off. Does it investigate thoroughly? Does it communicate clearly? Does it reinforce confidence that the rules still apply? Or does it allow ambiguity to linger? History offers some perspective here. Markets haven't always been as regulated as they are today. There were periods, especially in the late 19th and early 20th centuries, when access to information was one of the primary edges in trading. Those closest to power, whether corporate or political, often had advantages that others simply couldn't match. Over time, reforms were introduced to level that playing field. Disclosure requirements, insider trading laws, surveillance systems, all designed to reduce information asymmetry. Not eliminated entirely, because that's impossible, but limited enough to maintain trust. And for the most part, those systems have worked reasonably well. But they were built for a specific kind of world. A world where the most sensitive, market-moving information was largely corporate in nature. Today, that's no longer always the case. Macroeconomic policy, geopolitical decisions, regulatory shifts, these can move markets just as dramatically, sometimes more so. And the pathways through which that information flows are inherently more complex. That doesn't mean the system is broken, but it does mean it's being tested in ways it wasn't originally designed for. And April 9th may be one of those tests. Because at its core, this isn't just a story about a trade. It's a story about timing, information, and the thin line between insight and advantage. Somewhere, someone made a decision to take on a massive, short-term position in a falling market, minutes before a reversal that few were expecting. That's the fact pattern. Everything else, interpretations, the theories, the debates, flows from that. And maybe, over time, more clarity will emerge. Investigations may progress. Data may be analyzed more deeply. Connections, if they exist, may surface. Or maybe they won't. Markets have a way of moving on, even from the most unusual events. New narratives take over. Attention shifts. What once felt urgent becomes background noise. But every so often, a moment sticks. Not because it was fully explained, but because it wasn't. Because it leaves behind just enough uncertainty to keep people thinking about it long after the charts have moved on. And April 9th feels like one of those moments. 15 minutes. In a market that processes information at lightning speed, that gap is almost invisible. And yet, In this case, it's everything.